What if I told you there's an ETF that has beaten the S&P 500 every single year for over 2 decades? Or that semiconductor ETFs could potentially turn regular monthly investments into 6-figure returns? The year 2026 is shaping up to be a turning point for savvy investors. And if you're holding the wrong ETFs, you could be leaving massive returns on the table. In the next few minutes, I'm going to reveal 5 powerhouse ETFs that analysts believe could crush the market in 2026, and the reasons why might surprise you. Stay until the end because number 3 on this list is benefiting from a trend that most investors are completely overlooking. Coming in at number 1 is the Vanguard Growth ETF, ticker symbol VUG. Now here's what makes this fund absolutely remarkable. Since its establishment in 2004, VUG has outperformed the S&P 500 every single year. Not most years, not just good years, every single year. That's an undefeated streak spanning over 2 decades. So what's the secret? VG tracks the CRSP US Large Cap Growth Index, which means it invests in the top 85% of American companies by value that show strong growth characteristics. Think of it as the SP 500, but with the volume turned up on the companies driving the most growth. Here's where it gets interesting for 2026. The fund has massive exposure to artificial intelligence leaders. Its top holdings include Apple, Microsoft, Nvidia, Amazon, and Broadcom. These aren't just tech companies anymore. They're the infrastructure providers for the AI revolution. Nvidia's CEO Jensen Huang predicts data center operators will spend $4 trillion on AI infrastructure by 2030. That's trillion with a T. The fund delivered a 16.3% return in 2025, beating the S&P 500's performance. And with its expense ratio of just 0.04%, you're keeping almost all of your returns. What makes VUG especially compelling for 2026 is its passive, sector-agnostic approach. If AI stumbles, the fund automatically rebalances toward whatever companies are actually delivering growth. You're not making a bet on one technology, you're betting on American growth itself. Number 2 is the iShares Semiconductor ETF, ticker SOX. If you want pure exposure to the AI hardware boom, this is your play. SOX holds just 30 companies, making it highly concentrated compared to most ETFs. But that concentration is the point. Every single holding is a company that designs, manufactures, or distributes semiconductors. You're getting Nvidia, AMD, Broadcom, Intel, Qualcomm, and Taiwan Semiconductor Manufacturing all in one fund. Here's why 2026 could be massive for semiconductor ETFs. Morgan Stanley predicts tech giants will spend $300 billion on AI data center infrastructure and chips in 2025 alone. But that's just the beginning. The spending forecast could grow even larger in 2026 and 2027. Think about it. Every AI model, every data center, every autonomous vehicle, every advanced smartphone needs cutting-edge chips. And this ETF owns the companies making them. Recent news has been explosive. AMD just announced a major partnership with OpenAI to deploy AI infrastructure using AMD chips, with the first gigawatt deployment expected in late 2026. This validates AMD as a serious competitor to Nvidia and shows the AI spending frenzy isn't slowing down. Now, full transparency, SOX is down about 21% from its record high, which actually presents a potential buying opportunity. Since its inception in 2001, it has delivered an 11.1% compound annual return, beating the S&P 500's 8% over the same period. The expense ratio is 0.35%, slightly higher than broad market funds, but reasonable for a specialized sector ETF. The risk: if AI doesn't live up to the hype, semiconductor stocks could pull back significantly. But given the trajectory of AI development and infrastructure spending, that seems increasingly unlikely as we head into 2026. Number 3 might be the most overlooked opportunity on this list, the Avantis US Small Cap Value ETF, ticker AVUV. Small cap stocks have been the forgotten corner of the market for years, massively underperforming large caps. But here's what's changing for 2026. The Federal Reserve has begun cutting interest rates, and this is rocket fuel for small cap companies. Why? Small companies rely heavily on borrowed money to fund growth. When borrowing costs fall, their profit margins expand dramatically. AVUV isn't just any small cap fund. It's actively managed with a focus on small cap value stocks that are both cheap and profitable. The fund holds 785 companies with an average market cap of just $3.2 billion. It uses proprietary screens to find undervalued companies with strong cash flows, high profitability, and solid fundamentals. Here's the opportunity: small cap stocks are currently trading at their largest discount relative to large caps since the dot-com bubble. The Russell 2000 trades at a PE ratio of about 24, while the Nasdaq 100 is over 30. Small caps are on sale. Since its launch, AVUV has beaten its benchmark with a 20.3% return over the past year. The fund has over $18 billion in assets under management and charges just a 0.25% expense ratio. Financial stocks make up 27% of holdings, followed by consumer discretionary at 19% and industrials at 18%. As rate cuts continue through 2026, small cap value stocks could finally have their moment. This is the contrarian play on this list, and contrarian plays often deliver the biggest returns. Number 4 is the Vanguard Dividend Appreciation ETF, ticker VIG. Now, you might be thinking dividend stocks are boring in an AI-driven market. Think again. VG tracks companies that have increased their dividends for at least 10 consecutive years. These are financial fortresses with proven business models and consistent cash flows. But here's the twist: VIG has 26% of its portfolio in technology stocks, including Microsoft, Apple, and Broadcom. That's way higher than typical dividend ETFs. This unique positioning gives you the best of both worlds. You get the stability of dividend growers plus meaningful exposure to the tech giants driving market returns. The fund has consistently outperformed the S&P 500 with a compound annual return of 13.7% over the past decade, compared to just 11.61% for competing dividend ETFs like SCHD. The current dividend yield is around 1.8%, which might seem low. But remember, these companies are growing their dividends year after year. The yield on your cost basis increases over time. Plus, with an expense ratio of just 0.05%, you're getting premium dividend growth exposure for pennies. For 2026, VIG is positioned to benefit from multiple tailwinds. If the market gets choppy, dividend growers provide stability. If tech continues to surge, you've got that covered too. And as rates fall, investors will increasingly chase the reliable income these stocks provide. It's defensive and aggressive at the same time. 5 is the Invesco QQ Trust ETF, ticker QQQ. This is the purest way to bet on technology and innovation continuing to dominate markets in 26. QQ tracks the Nasdaq 100, which includes the largest 100 non-financial companies on the Nasdaq exchange. It's tech-heavy by design, with Apple, Microsoft, Nvidia, Amazon, Meta, and Alphabet making up over 40% of the fund. These are the companies spending hundreds of billions on AI development. The fund has crushed the S&P 500 in recent years. Over the past decade, QQQ has significantly outperformed, driven by the digital transformation of the economy. With AI spending expected to accelerate, cloud computing growing, and digital advertising rebounding, the companies in QQQ are positioned at the center of every major tech trend. Meta just announced they're planning capital expenditures of $66 to $72 billion for 2025, with similar spending projected for 2026. Amazon, Microsoft, and Alphabet are following similar playbooks. All that spending flows to the companies in this ETF. The expense ratio is a reasonable 0.20%, and the fund has over $300 billion in assets, making it one of the most liquid ETFs in existence. The risk is concentration. If tech stumbles, but if you believe the next decade belongs to AI, automation, and digital innovation, QQQ gives you front-row seats. 5 ETFs positioned to potentially beat the market in 2026. View for undefeated growth exposure. SOX for concentrated semiconductor plays. AView for the small cap value opportunity. VG for dividend growth with a tech twist. And QQQ for pure tech dominance. Here's my take: the strongest portfolio would include a mix of these strategies. Maybe a core holding in VUG or QQQ for growth, a tactical position in SWX to capitalize on AI infrastructure spending, and AVUV to benefit from rate cuts and small cap mean reversion. VEG could provide stability and income as a portfolio stabilizer. Remember, past performance doesn't guarantee future results. These ETFs carry different risk profiles, and you should consider your own investment timeline, risk tolerance, and financial goals before investing. But if the trends we've discussed play out, these 5 funds are positioned to deliver. The market is always evolving, and 2026 could be the year that many overlooked opportunities finally shine. If you found this analysis valuable, smash that subscribe button and hit the bell so you don't miss our next deep dive. Drop a comment below telling me which ETF you're most excited about for 2026. Are you going all in on semiconductors, or are you a small cap contrarian? Let's discuss. Thanks for watching, and I'll see you in the next one. Now go build that wealth.